Welcome everyone to today's lecture. We stopped here at section and chapter 4. We've talked a lot about the traditional commercial banking with deposit taking and lending, and we'll now turn to investment banking. And as you can see, after a short introduction, I'll quickly go through the sub-chapters here: valuation, leverage buyouts, M&As, IPOs in trading and structuring, because these are the most important fields investment banking. Now, up until now, we have talked about lending and deposit taking, and that's usually the traditional part in banking. But as soon as you turn your focus on to institutional investors, wholesale lending, and more capital markets related activities, you enter the realm of investment banking. And we'll talk about the main fields in investment banking. There's not a clear-cut definition like in commercial banking, but usually investment banking entails all the activities of a bank that are related to capital markets. That means valuation is one part in investment banking. Leveraged buyouts are IPOs, M&As, but also trading and structuring, and we'll discuss each of these fields in investment banking in a bit. Just a short introduction: what is an investment bank? An investment bank is a financial institution that helps their clients with wealth management, raising capital, and trading securities. And raising capital usually means by issuing new securities or by advising a company on how to do a merger, on how to do an IPO, on how to do a seasoned offering. In contrast to commercial banks, they do not take deposits, and that's the defining part of this definition of an investment bank, because in many research papers, it's often hard to distinguish whether a bank is a pure investment bank or a pure commercial bank. What you will usually find in most countries is that banks do both. Like, for example, Deutsche Bank, they are active in commercial and corporate banking, but also in investment banking. And how can you measure the extent to which a bank engages in investment banking? And what is usually done in research, there is one, I wouldn't go so far as to say famous paper, but a very influential paper by Markus Brunnermeier from Princeton University, that in the paper, the authors use non-interest income. They just use the ratio of non-interest income to interest income as a proxy for the extent to which a bank engages in investment banking, meaning that usually if you take deposits and if you give out loans, you will earn interest and you will have to pay interest on your deposits. That creates and generates your interest income. For everything else, for all the services you provide customers in investment banking, you'll usually be paid a fee or a commission. And that is your non-interest income. That is your income that is not related to interest rates. And therefore, by looking at the ratio of non-interest income to interest income, you get an approximate value, an approximate measure of the extent to which the bank engages in investment banking. But this is quite fundamental. And an investment bank does not take deposits. Why? And why do many regulators stipulate that a bank that takes on deposits is prohibited and forbidden to engage in investment banking? As we'll later on see, investment banking is much riskier and carries much more risk than commercial banking. But if investment banking usually entails more risk-taking, regulators often demand that this risk-taking is not financed by customer clients, which should be safe and should be free of risk. So this is the reason why in many countries you have a separation between commercial banking and investment banking, and banks that engage in investment banking are forbidden from taking on deposits. So this is a definition of an investment bank, and we'll now try to get a better idea of what investment banking is by first of all stating that you have one possibility to differentiate between two major sides of the business, the buy side and the sell side. And buy side and sell side means that the investment bank engages with clients by trying to sell assets or by advising customers on how to get financing. So the buy side related activities usually are advising companies on which future investments they should buy, on securitization, the sale of created financial products, so-called financially engineered products. And the sell side usually encompasses securities trading, market making, underwriting, marketing during an IPO, research and analyst reports. If you've ever heard about financial analysts, usually these work for investment banks or asset managers, but mostly for investment banks. And they will do research on investment opportunities, on assets, and they will file reports and create reports. And then you can see, for example, that the analyst at Deutsche Bank covering, say, Daimler, says you should buy or sell the stock. So these are analyst reports. This is one part of the business investment banks do. Now, as you can see, we have the public buy side, where usually clients have capital principles. They want to invest. You have institutional investors, and they want to buy assets, and the investment banks will sell assets or financially engineered products to institutional investors. By the way, one has to note that investment banking is usually fully limited to the business between the bank and institutional investors. So retail customers are completely out of the picture here. We are talking about a B2B business between the bank, the investment bank, and institutional investors. That's the buy side. And on the sell side, the investment bank engages as an agent of capital. And you have companies, for example, here that are in need of capital and that require the assistance and the consulting of the investment bank. And the investment bank will try to provide their clients with financing and with capital. So you have the asset on the buy side and the sell side. Okay. The activities of an investment bank can further be divided into activities that are related to the front office, the middle office, and the back office. Now, all three offices are described on the next couple of slides. I'll just try to describe it without using the slides. The front office is usually the part of the business where employees of the investment bank will try to advise or sell their principal clients, aka the institutional investors. And this could, for example, mean that you have, I always bring these examples from movies. You might have seen Wall Street, you might have also seen The Big Short. And in some Hollywood movies, you can see that people work at a broker, at a stockbroker, and this is quite closely related to what in the investment bank would do. They also act as a stockbroker. They will try to sell investment products, assets, to institutional investors, and you have people engaging with clients and trying to sell, for example, financially engineered structured products. And actually in The Big Short, you can see this in one scene where Christian Bale goes to, I think, JP Morgan or Morgan Stanley and asks the investment banks for a specific financial product, in that case, a credit default swap. He wants to buy insurance against the default of certain portfolios and mortgage portfolios, and then the front office, that is the investment bankers together with a couple of quants, quantitative analysts. They will say, yes, we are able to sell you this financially engineered, this structured product for a price of so-and-so millions. That's the front office. They will engage with customers and clients, and they will sell products, or they will engage with clients and talk about possibilities of doing an IPO, of raising capital, etc. Middle office is risk control and risk management, in short. Actually, middle office in German, we also have a slightly different name for that. It's usually not just risk management, but rather risk controlling, Risikokontrolling, which means that you're not really actively managing risk here, like in risk management. You sometimes do that as well, but you rather do risk controlling, or controlling is a German word. I mean, it's Risikokontrolling, meaning that you try to limit risk. The front office does business, and the middle office looks at the risk taking of the front office and will put a stop to it in case risk is too high. So they will manage some of the risks, but it's at this point it's just rather risk monitoring. So that's the middle office. And what's the back office? IT, transaction services, and facilitating the transactions done by the front office and controlled and monitored by the middle office. Those are the three offices: front, middle, back office. And obviously they're called front, middle, and back office because of their proximity to the bank's clients. Front office engages directly with clients. Risk management does not, and definitely not the back office. Okay. So this is the front office: sales and trading, proprietary trading, research, acquisition of potential M&A clients, and so on. So this is where services and products are marketed to clients. Middle office is risk management, corporate treasury, in German Finanzrisikokontrolling. And the back office is tech control, transaction services, IT, which is, it sounds a little bit boring. Yeah? Front office is where you are selling stuff to clients. Risk management, that's still okay, but back office sounds like that's the secretary in the back and the tech support guy. Actually, it's not that simple, because in this case here in the IT, this can also include algorithms and algorithmic trading, which is highly sophisticated, obviously. So this is not just tech support, but this could also include rather complex programming and algorithms for algorithmic trading. No? That's a back office. Okay. And obviously, IT should make no mistakes when millions and millions are transferred from one customer to the bank, or other way around. So back office is definitely important. And quite interestingly, if you have followed the news, Deutsche Bank, as a huge player in the global banking system, it has had some severe problems in the investment banking section as well. And it's quite funny that one thing they complain most about is their outdated IT and their old IT systems. And I think it was the chief technology officer, or the chief IT officer of Deutsche Bank, who famously said that Deutsche Bank is, I think she said, Deutsche Bank is the most dysfunctional company she's ever seen. Afterwards, she was sacked and she was fired, partly due to that statement. But I know from first-hand, rather second-hand experience that it's actually quite a big problem that the back office in the IT is too old and outdated in especially large companies. It's quite clear that you cannot simply change these systems. If you have large databases, if you have systems, IT is quite expensive, but what is even more important is you cannot simply switch your IT system in such a huge organization from one day to another. You need to have a project management, and you need to roll out the new IT and the new systems, and they need to work. You cannot simply say, okay, we'll close down our business for a couple of months and then start with a new IT, but you need to you do this while, in German we say, while operating, while having open heart surgery. That's the image we have. Okay, so back office, although it sounds rather unimportant, it's actually it can be quite important for the bank. Now, a question for discussion, because this is something that is usually mentioned in the context of investment banking. A Chinese wall. What is a Chinese wall? You've now seen front, middle, and back office, and buy-side and sell-side activities, and commercial banking and investment banking. You have a broad understanding of what investment banking is. Now, what could a Chinese wall be? What is a Chinese wall? Any idea? No? A Chinese wall is an organizational separation of information flow and data between parts of a company. Meaning, for example, no information is exchanged between, for example, branch A and branch B of a company. Could, for example, if we take the university, we could, for example, say we have a Chinese wall between two faculties. We cannot simply exchange data. And if this is intended, if you don't want information to be exchanged between two parts of your company, that is what a Chinese wall is called. It's called a Chinese wall. Now, where would a Chinese wall make sense in an investment bank? A little Christmas music. Between a front and middle office? No. If you sell something, you need to control and manage risk. Makes no sense. Middle office and back office the same. Back office is has the purpose of facilitating and enabling the transactions done by the front and the middle office. So you don't need a Chinese wall there, but you usually have legal requirements that you need to have a Chinese wall in place between some some buy side and some sell side activities, and definitely between investment banking and commercial banking. Why? Now, there's a huge potential for a conflict of interest. Imagine the following situation. You're a company. Say you are a company, you want to go public with your stock, you want to do an IPO. I'm acting as the investment bank that guides you through your IPO. And I'm an advisor in the IPO. I will earn a lot of money by trying to help you raise capital. For this to work, I need to have full access to your confidential data. Meaning I need to know what your books look like, how much you as a company are worth. I need to do a valuation. That is, by the way, that is why the first part in a couple of slides will be valuation. I need to do a corporate valuation. Then that's my my sell side. But then, obviously, I could also, another part of my investment bank could also try to market your stocks. That's okay in case I'm involved in the IPO. But then I also have analysts who cover capital and stock markets. Now, obviously, there's a conflict of interest if these analysts who are intended to be neutral and to give advice to institutional investors, if they were to give out confidential data I've received as part of the IPO, or if these analysts would say, oh, the stock is 50 euros worth, if actually it's only worth 30. So I have private data, I should not exploit this, but also I have a reputation to lose if my analysts use confidential data or if they try to defraud investors. So there's a conflict of interest. And then next, obviously, if I'm also a commercial bank and I've given out loans to you, there's a huge conflict of interest there, because as an investment bank, let's assume I'm not involved in an IPO, I've simply given out loans to you. So I'm hopeful that you will be able to repay 10 million euros. If I see that you are in debt and if you are close to default, I will lose my loans. Now, what could I do? I could tell my analysts in my investment banking branch and tell them, advise all institutional investors that this company is not bankrupt. It's not on the verge of default. And market participants might believe this. And this could help you stay longer in the game. And it could help me to retrieve my loans. And that's the conflict of interest, especially between investment banking and commercial banking. I might be tempted to influence a company and markets in order to increase the probability of a loan being repaid to me in my commercial banking branch. But you have a question?
Does this have to do with insider information?
It's not. Yeah, it's not exactly insider trading, but it's definitely market manipulation. Insider trading would mean that it would be insider trading if I were to trade on the stock, but it's not even market manipulation. I'm not trying to, I'm trying to manipulate the market. But insider trading would mean that I've given out a loan and I'm trying to buy or sell the stock, which I'm not. But I'm trying to use misinformation, and I'm trying to use my investment banking to get my loans back. And that is a problem.
Get other people to buy the stock.
Yeah, maybe not to sell them, and other companies to give out additional credit to the company. So there, and in these cases, you should have a Chinese wall inside a company. If they work, that's another question. But you should have a Chinese wall in place, meaning that these two branches of your company, of your bank, are not allowed to speak to each other on the matters of these customers. By the way, it's quite interesting that, for example, if you work in investment banking, if you work on a trading floor, you are constantly monitored by regulators, by supervisors. And for example, all phone calls made on a trading floor, they are all recorded and can be audited by the supervisor to prevent market manipulation and insider trading. So regulations are quite stiff here.
Could you please repeat what the conflict between buy and sell side is? You mentioned the conflict between commercial and investment banking, and the conflict between buy and sell side.
If you take, for example, analyst reports and research, in this case, in research, you are offering customers information for a fee, like a rating agency or like a consulting company. You are filing reports, you're writing reports. For example, if I'm an investment bank, I could write a report. I'm an analyst covering the business of, say, Daimler. And I will gather public information. I will talk to people and I will write a report saying the stock of Daimler is a definite buy, and the stock price will go up. I'm using public data, and this is just something also researchers could have done. That's an analyst report. But if some of my colleagues in the investment bank are currently working together with the customer, in that case Daimler, on a totally different investment or an IPO, they might have access to public data. And if, for example, they are advising, if it could, for example, be that they are advising the company on a seasoned offering, that the company needs to raise capital and they want to issue new stocks. And that would be a problem and a conflict of interest, because the people working in the IPO section could then just tell their analysts in the research department, try to, how do you say that in English? Schönreden. You can simply, the analyst will try to make the customer appear in a good light. And that's a conflict of interest, because the analyst should be neutral and objective. And the IPO section obviously works for the client, is paid by the client, and is paid for good marketing of the news or of these stocks. And then there's a conflict of interest. The question, in some countries, this is obviously forbidden. In some other countries, it's not forbidden. But banks should make a separation here and insert a Chinese wall on their own, in their own interest. Because if, for example, you are the investment bank advising a company in an IPO or a seasoned offering, investors will notice if your analysts suddenly start talking up a client for no good reason. And then that would definitely hurt your reputation as a good investment bank. There are some papers, I think, there are some papers out in the 80s and 90s, I think, that looked at reputational effects at investment banking. Obviously, not all of these conflicts of interests are regulated and forbidden by law. Okay. Some of the world's biggest investment banks, actually Bank of America, Credit Suisse, Deutsche Bank, Citi, Barclays, Goldman Sachs, Morgan Stanley, JP Morgan, UBS, Wells Fargo Securities, also some Japanese banks, Nomura is a large trading house, and some of these are pure investment banks like Goldman Sachs. Some of these are commercial and investment banks like Credit Suisse and also Deutsche Bank, Citibank, and Citigroup actually as well, and Barclays. But these are the world's largest investment banks. You can see these are the top 10, or were the top 10 in 2014, and the commission income, JP Morgan, Bank of America, Merrill Lynch, Goldman Sachs, Morgan Stanley, Citigroup, Deutsche Bank, Credit Suisse, Barclays, Wells Fargo, and UBS. Has changed a lot since then. Actually, Deutsche Bank has gone down, I think. Goldman Sachs, I think, is at the top again. And as you can infer from the names, there was, I've already mentioned this, after the Gramm-Leach-Bliley Act, the Gramm-Leach-Bliley Act in the 90s, as part of the deregulation of the financial system in the US under the Clinton administration, banks were suddenly allowed, or not suddenly, but banks from there on were allowed to engage in both commercial and investment banking, because the Gramm-Leach-Bliley Act repealed parts of the Glass-Steagall Act from the 30s. And after that, what would you do if you are a commercial bank and you want to start an investment bank? You either start from scratch, or you simply buy up an investment bank and you merge, or you do an acquisition. And this is what happened in the 90s and 2000s. Banks merged and merged and merged, and they bought investment banks. That is why, for example, in the beginning, the investment bank branch still carried the names or their former names with a pretext, not pretext, but a prefix. You can still see it here, Bank of America Merrill Lynch. Obviously, Bank of America bought Merrill Lynch. Then JP Morgan Chase and Dresdner Bank, German bank that was part of Allianz at some point, and then was sold off to Commerzbank. Dresdner, back in the 2000s, it was Dresdner Kleinwort Wasserstein. That was the investment banking branch of Dresdner Bank. Deutsche Bank, I think Morgan Grenfell. They bought a UK-based investment bank, Deutsche Bank Morgan Grenfell, and so on. And during that era, all the large banks merged. Then, next to these large investment banks, you also have some selected boutique investment banks. And this is quite interesting because this name boutique investment bank is also common in consulting. You might know the large strategy consulting companies like McKinsey, Boston Consulting Group, and so on. And what happens from time to time is that at some point, a couple of equity partners of a large consulting firm or a large investment bank, they realize that they bring in the clients, they make the money, but in a large organization, they don't have the power they want to, or they want to concentrate on some part of the business in such a large organization, like for example Deutsche Bank or Boston Consulting Group or McKinsey. Some people realize, okay, this organization has grown too huge, too large for us to make the type of business we want to do. And then what happens is, in these industries where you have high need for intellectual power and intellectual capital, these people build their own company. And this is usually when boutique companies open up, and you have boutique investment banks and boutique consulting firms. Maybe an example. For example, my former employer that was founded, I think, back at the start of the millennium, Define. I think they now have 500, 600 employees and consultants. They used to be the risk management branch of Arthur Andersen. And when Arthur Andersen blew up, or shortly before that, the partners and some of the managers thought, okay, let's open up a new company. And that is how this company was founded, and I would say it's a boutique consulting firm for risk management. Same with investment banking, and there are a number of boutique strategy consulting companies that are formed by former McKinsey or Boston Consulting Group partners. They are not as large as these companies are, but they sometimes have 20, 30 or 40 employees, and they just concentrate on a select group of customers and clients. And investment banks do the same. They usually do not offer the full range of services, but they concentrate on a type of consulting service, or they concentrate on a certain industrial sector because they have such a profound knowledge of that sector. And here are some examples of boutiques, and these are actually the elite boutiques, so the better known elite investment banks: Evercore, Greenhill, Lazard, and Catalyst and Moelis and Company. And there are others, but these are some examples of elite boutique investment banks, and they concentrate on some specific service or industrial sector. Okay. Now let's turn to valuation. I mentioned earlier that part of investment banking includes the valuation of a firm, and why is that? Well, investment banks support their clients in financing decisions, in investment decisions, in guiding clients through IPO and M&A processes and decisions. And in almost all of these services, you need to know what an asset or a company is worth. If you want to know what a stock is worth, or an investment is worth, or a bond is worth, you need to know the value of the firm. And if you want to merge or buy a company, well, obviously you also need to know what the company is realistically worth. So you need to do a valuation, and that is most of the time based on annual financial statements and available capital market data. And before discussing now the basics of firm valuation, we simply talk a little bit about the basics of firm valuation and balance sheet analysis. For this, I've brought you a rather antique balance sheet of Ryanair from 2007. I think you pretty much know the main details of a balance sheet. You have the asset side, you have the liability side, you have non-current and current assets and liabilities, you have equity, and here in this case I think it's quite instructive, yeah. Quite instructive to look at the balance sheet and keep in mind what type of business Ryanair is doing. For example, if you look at the asset side, you will see that they have a lot of property, plant and equipment. Those are the airplanes. And for an industrial company, in comparison to financial corporations, you will see that they have, at that time, 11 years ago, they had a huge equity ratio. As you can see, they have total liabilities and total assets of almost 6 billion euros, and they had shareholders' equity of 2.6 billion euros. So that's quite a huge debt to equity ratio compared to compared to financial corporations. This here is the income statement, especially if you are not versed in reading an English balance sheet and income statement. I advise you to go through it to get a little bit acquainted with the terms. For example, this is an income statement, in German Gewinn- und Verlustrechnung, and you start with the operating revenues, you have operating expenses, and at some point you have the profit before tax and the profit probably for the period after taxes, and in this case Ryanair had a profit after tax of 455 million euros, and not surprisingly you can see that the largest position here when it comes to operating expenses was fuel and oil. That's the kerosene that is used by the planes. Okay. Now that's a balance sheet and an income statement. We also have the consolidated cash flow statement, cash flow Rechnung. I think they should be known to you if you have taken the accounting class, but what is more important is how we can use this data to arrive at a value for the firm. First, we need to know, and we need to note that it's quite difficult to compare one statement of a company to the statement of another company. It might also be difficult to compare two statements from the same firm that are taken from two points in time with each other, because first of all, you might encounter different accounting systems. Some companies use IFRS, some companies use German HGB, some others accounting documents are done using US GAAP. There might be different accounting rules among business sectors, especially it doesn't make sense to compare a financial to a non-financial company. We've just seen that, for example, the equity ratio is much higher for industrial firms than for financial firms. And it doesn't make sense to compare ratios and it doesn't make sense to compare actual figures from a balance sheet from a small company to the ones taken from a large company. So what you can do is in many cases, you need to compare a firm for which you need to do a valuation with ratios and percentages from other companies. So we'll talk about ratios. A nice advantage of ratios is that they are also indifferent and independent of currencies. That is a frequent mistake often made in theses, in empirical theses, that you use data and as soon as you start to do a comparison of international companies, you start to compare figures and ratios from taken from the balance sheets of these international corporations. But what you should do, ideally, is you should convert all those figures into one currency, because then you can exclude exchange rate risk. And this is a nice advantage of ratios, of percentages, that they are also indifferent of changes in currencies. Okay. Now, the first thing one could do is simply take the balance sheet and divide every position by total assets. Then, obviously, we have total assets 100%, total liabilities and equity 100%, and you can see Ryanair had an equity ratio of almost 44%. They had 55% of their assets in planes and plant. They had 25% of their assets in cash and cash equivalents, which is quite high. And they had non-current maturities of debt 32%. Okay, so long-term debt, that is. It is a different type of information, but when it comes to comparing companies, this might help you more than the sheer numbers. If I would tell you, for example, that Ryanair had 2.3 billion in equity. If it's a large, if I, for example, would say, oh, Lufthansa has slightly more equity than Ryanair. Ryanair has 2 billion and Lufthansa has 2.5 billion. That doesn't give you too much information, because Lufthansa is also a much larger, or used to be a much larger company at that time. You know? So you need to compare ratios and percentages. This is one way of doing it. The same with the income statement. For example, here you take the total operating revenues as 100%, and then you divide everything by the total revenues. And you can see that, for example, 28% of the operating revenues are again spent on fuel. And afterwards, in the last line, you can see that almost 21% profits are generated on every euro in operating income, operating revenues. Okay. Okay. So that's one way of doing it. What could you do next? You could try to look and forecast the time trend of ratios and percentages. That would be a time trend analysis. Or you could do the same at one point in time, but in the cross-section of companies, and use peer group analysis. What is peer group analysis? What could that be? Something very simple, each and every one of you would do in such a situation. If you have a company, you want to, if I told you that you can buy the stock of, say, this Shoe City store here. If they did an IPO and you wanted to know what is this company worth, what could you do? You could look at the 5 main competitors, see that, for example, the 5 main competitors have certain ratios, certain financial ratios, and then you would analyze the balance sheet and income statement of this particular company you want to value, and then look at how the company fares in a comparison to its 5 main competitors. If you see, for example, that this company has more equity, generates more revenues, and has a higher profit then it's competitors, then it's definitely a buy. If you see that the operating revenues are lower compared to the ones of its competitors, you would definitely not buy this company. So that's peer group analysis. You take ratios and you compare the ratio of your company you want to value with the ratios of a peer group. What ratios are there? Roughly, financial ratios can be divided into the following groups. We have short-term, also called liquidity ratios, leverage ratios, turnover ratios, profitability ratios, and market value ratios. Solvency, short-term solvency is liquidity. Long-term solvency is actually sometimes just referred to as solvency, but this has to do with financial leverage. In German, this is also the distinction. We have Liquidität und Solvenz, meaning liquidity is relevant when it comes to the short-term risk of bankruptcy. You might be solvent and you might have enough equity, but if you run out of cash because all your cash and money is tied up in long-term assets, you can become illiquid and you will go bankrupt and default even though you might have enough equity on your balance sheet. And long-term solvency, in contrast, is the question whether you have too high leverage on your balance sheet. In turnover ratios, profitability ratios, and market value ratios, these are, I think, quite clear. Let's look at some examples. We'll start with the current ratio. It's one of the best known and most understood ratios in financial analysis. It's just current assets over current liabilities. Quite simply, what can you liquidate short term, and what bills do you have to pay in the short term? And in this case of Ryanair, they have a current ratio of 2.11. What does it mean? For every euro they need to pay a bill in the short term, they have 2.11 euros in short-term assets that are either cash or cash equivalent or can be liquidated with ease so that the bills can be paid. That's a current ratio. Quite simple. It's a short-term solvency, it's a liquidity ratio, and it's a very general or generic, plain vanilla liquidity ratio. For banks and insurance companies, these look different. Why? Because accounting is completely different for insurance companies and banks than for industrial companies. So this is a very generic definition for industrial companies. That's a current ratio. Looks quite nice for Ryanair. How can it be interpreted? For creditors, obviously the higher the current ratio, the better, because it means that the company is able to pay its bills. For a company, a high current ratio indicates sufficient liquidity, but can also indicate an inefficient use of cash and other short-term assets. If you have a current ratio of, say, 10, that means that for each euro in bills you need to pay short-term, you have 10 euros sitting around idly in your balance sheet that are not generating any profits. Cash doesn't generate profits, investments do, assets do, but not cash. So a high current ratio is just nice for creditors and for the people who have given you financing, but for you as a company, that is actually, it's okay, you are very liquid, but you're not generating any profits. A current ratio of at least 1 is obviously desirable, and a current ratio of less than 1 expresses that the net current assets are negative and you're close to bankruptcy. Or economically you are already bankrupt. Long-term solvency ratio, the total debt ratio, that's just total assets minus total equity over total assets. That's the total debt ratio. Debt over total assets, yeah.
Is it normal for industrial companies to have a ratio over 3 or 4 because they have to, like Ryanair, they have to buy a lot of fuel?
I guess it depends on the industry you are in. Another reason why this is not suitable for banks and insurance company actually is because they have liquidity regulation. Banks and insurance companies have strict liquidity risk regulation, meaning that they have slightly different ratios they need to calculate, they need to report to regulators and supervisors, and if they don't fulfill certain minimum requirements on liquidity risk and available liquidity, they will be shut down by supervisors. And I guess each industrial sector has its own average level of liquidity. Depending on the type of business they are in, I think it's quite right that they will keep more or less liquidity. For an airline, I would guess, they need a certain level of liquidity. The question then is whether they can reduce the need for such high liquidity by doing hedge, by hedging their price risk. I mean, they need to buy, obviously they need to buy oil and kerosene, but they should be quite active in risk management and hedging their commodity risk. And that might be a reason why the liquidity need is reduced to some extent. But there are other industries in which I guess the need for short-term liquidity is much higher than in other industries. Now when it comes to leverage, we have the total debt ratio. That's just total debt over total assets. You can also define total debt to total equity. Then you have the debt to equity ratio, or here total liabilities over total equity, and also the equity multiplier, which is total assets over total equity. And in this case of Ryanair, they used 56% debt, and for each euro in assets, they financed these assets by 56% debt. That's quite low, but not too uncommon in industrial sectors. In banking, it's totally different. Banks have 95 to 97% debt. Profit margin, profitability measures. Quite simple, net income over revenue leads us to the profit margin. And a relatively high profit margin is desirable as it corresponds to low cost to sales. It's a profit margin. However, while reducing sales prices usually leads to increased sales, it reduces profit margins at the same time. And similarly, the total income could have gone up or down, and therefore it is not necessarily bad if margins are smaller. It depends on how many products you sell and how many services you provide. And that is why some other profitability margins are used more frequently. For example, the return on assets. Net income over total assets, in the case of Ryanair, there was 7.75%, meaning that they generated almost 8% profit on each euro in assets. That's the return on asset. From this, we can also distinguish the return on equity. The return on equity is net income over total equity. And as you would expect, the return on equity is obviously higher than the return on assets. And in this case, it's almost 18%. Why should the return on equity be higher than the return on asset? That should be clear. Debt doesn't carry the risk equity does. Therefore, debt should be cheaper than equity, and you have a risk premium in the return on equity. Clear? If not, I guess you should go back to Finance 101. Debt equity. Okay. 18% return on equity, quite high actually, but you should keep in mind that 2007 was the time when Ryanair was still going up. Well, the planes still go up, but business, I mean. and when they were expanding in Europe. Quite profitable, actually. And since ROA and the return on equity are frequently quoted figures, it should be emphasized that these are accounting returns. What does it mean? They are based on net income over total book assets and total book equity. Why? Why is it important to make this distinction? It's quite interesting that the band outside plays a little tune like in Jeopardy. Bum, 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 bum. These numbers, these figures, total assets and total equity, they are taken from the balance sheet of the company, and you can obviously distinguish the true objective asset value of the firm and the market capitalization as a current market, as the market's impression of what the equity is actually worth. That is why one should really note that these are returns on book assets and returns on book equity. They are not returns on market cap or returns on the firm's true asset value, right? Okay. Now, one interesting thing you can do with the return on equity is you can take the return on equity, multiply by assets over assets and revenues over revenues, slightly rearrange it, and you can see that the return on equity can be expressed as net income over revenue times revenue over assets times assets over total equity. And this is the famous DuPont method of expressing and decomposing the return on equity into the profit margin times the total asset turnover times the equity multiplier. And this is quite interesting because this formula gives you so much information on how you can increase your return as a shareholder. One way is to get a higher profit out of each euro in revenues. My famous example in our introduction to business administration is usually a pizza place. And how can you increase your revenues? Sell more pizzas. But increasing your revenues is just one part. You need to make sure that your income from each euro in revenues is higher. So the profit you are making out of each pizza needs to be higher. That is one lever you have. That is one instrument, one tool you have to increase your return as a shareholder. The second tool is the revenue over assets, meaning that if you buy a new pizza oven, you need to be able to increase revenues disproportionately to the assets you've invested. Make better use of your assets. That's the second instrument. You have to increase your return. And the third one is actually leverage. It's assets over total equity. And if you increase leverage, you can, lever your increase, and by using cheaper debt and being able to grow by using leverage, you can increase your return as a shareholder. And that is why I'm teaching this to our first year students in the introduction to business. People need to realize that debt isn't something bad. Yeah? And actually this is something that you learn by heart if you start investing on your own. And all people do this, even private households. Do you know when? When they start buying housing and buying houses. Because that's for a small retail customer. That's the only part in business where you can use leverage. You can buy a house. If you start buying a house or buying a flat, you finance it with debt, say 50% debt and 50% equity. If you rent it out, the place will finance itself. You can use the rent to pay off the loan, and if you make it right and if you are good in this, you can earn a profit. And then the people renting your place are actually paying for your house or your apartment. And then you can buy the next one, and suddenly you're a real estate mogul. And how? By using leverage. Not by using too much equity, but by using leverage and by using a good assets over total equity ratio. And that is interesting. And it's not related to the total return, to total income. No, it simply means that you can increase your return on equity by using leverage, total asset turnover, or the profit margin, and that's the DuPont method for looking at this. And in this case here, you can see we have a return on equity of almost 18%. We have a financial leverage of 2.27. We have an asset use efficiency of 36% and an operating efficiency of 21.4%. And by using one or two or all three instruments and levers, you can now try to increase your return on equity. Okay. Yeah. And another way of looking at this is, of course, not to use it to increase your return on equity, but to analyze the underlying reasons why your return on equity is possibly not as high as you wish it to be. So you can start looking for reasons why your return on equity is not as good as it is supposed to be. Then let's turn to market value measures. And first we'll start with the price-earnings ratio. Now, we've already talked a little bit about the share price that is usually not included in a financial statement, but which is a reflection of the data and information presented in the balance sheet. Now, obviously the share price is only available for listed companies, and also be sure to how should I put it? Remember the fact that just simply because a company is a stock company, is a corporation, doesn't mean that it's listed. These are two different things. Being a stock company or being a public or a listed stock company. What is the difference? In a listed company, the stocks are traded and listed on an exchange, and it's a public stock company. But you can also have a private stock company, meaning that the stocks are owned by investors and the stocks are not traded. You know? This is something people sometimes are a little bit unfamiliar with, that if they hear the word stock, they immediately think of stock exchange. But that doesn't necessarily mean that the stock is traded on an exchange. Okay. Then what is the price-earnings ratio? It's a measure of the market value of a company, and it is defined as share price over per share earnings. And it measures how much investors would pay per unit of current income. High price-earnings ratios are often treated as an indicator of a significant future growth. Why? The price-earnings ratio for Ryanair was, let's say, 60. What does that mean? Assume that Ryanair will earn €1 per share in income or in profits based on the current balance sheet. €1 in earnings per share. Then the market participants are willing to pay €16 to get this share. And what does a high price earnings ratio tell you then? It means that although Ryanair is currently only earning €1 in profits, people are still willing to pay €16 for this €1 in current profits. If the price earnings ratio goes even higher, people think that even though the company is not making too much money at the moment, I'm still willing to pay good money for the share. So it's an indicator of future growth, expected growth of the company. If the price-earnings ratio is just 1, it simply means that I would guess I just expect the company to go bankrupt next year, because for the euro in current profits, I'm only willing to pay exactly this €1 in profits, and then afterwards it's a gamble. So that's the price-earnings ratio. We can also use the market-to-book ratio. It's the per share market value divided by the per share book value. And mind that the per share book value equals the total equity divided by the total number of issued shares. And the per share book value is an accounting number that reflects historical costs. So what do you do? In other words, market value of equity divided by book value of equity. The market-to-book ratio. What does that tell you? If you were to start a company from scratch, say you use 100,000 euros in assets, and you finance this, let's say 10,000 euros in equity and 90,000 euros in debt. We haven't done anything. The company has been founded and we have 100,000 in cash. And we haven't invested it. What is the company worth? Obviously, the equity, which owns the property rights to the company, is worth 10,000 euros, because the company still has to pay back 90,000 euros, and the residual book value, and in this case the market value of equity, is 10,000, because no one would pay more if the company only has 100,000 lying around in cash notes. No market participant would pay more or less than the 10,000 euros in total for the company. The company now starts to make business. It generates profits, etc., etc. Or it has a future expected growth that is high. Now, let's assume for a moment these are quite talented managers, and we simply know that they will make good use of the 100,000 euros in cash. And we expect the company to grow. And suddenly, share prices will go up. And the market capitalization, the market value of assets and equity is, say, 20,000. The book value, however, is still 10,000. And this leads you to the market-to-book ratio. And it can be below 1, it can be above 1. And then you realize that it's a ratio that tells you again something about the market valuation of the company. If you have a high market-to-book ratio, if you have a low market-to-book ratio that is below 1 or above 1, you can infer from that what the market thinks about the future prospect of this company. That's why the market-to-book value is a good ratio, an interesting ratio of the market valuation of a company. So it compares the market value of investments of one company with its expenses. A value less than 1 would mean that the company was not successful to create value for shareholders in total. And for Ryanair, the market-to-book ratio, NUC book, was 2.75. So that's the market-to-book ratio for Ryanair. Okay. What do you do next in valuation? First, if you're interested in this, take Professor Dietrich's class. He has a class on Unternehmensbewertung, corporate valuation. What you usually would do is you use ratios and you try to estimate and calculate the price of equity. If you buy a company, you're buying the shares, the stocks, the equity of a firm. So you need to know what is the equity of a firm worth. One idea would be to look at the market capitalization. If you don't have a publicly listed stock for the company, you need to make comparisons based on the return on equity, and later on we'll see how you can do this. It's closely related to valuation and also to asset pricing, because you need to know the fair arbitrage-free price of a stock. And you can do many complicated things, or you can just do simple things. You take the return on asset or the return on equity of a firm, you use the equity multiplier, you calculate certain ratios for a comparable peer group, and then just look at how much the company should be worth, given that other companies have this or that price, or this or that share price. It's actually quite simple. Okay. Then now let's turn to leveraged buyouts. That's another important part of investment banking. Investment banks often operate as advisors and analysts during leveraged buyouts. What is an LBO? In a leveraged buyout, an investor or group of investors buys a target company and finances this purchase with a small amount of equity and a substantial amount of borrowed capital. And the profits and assets of the target company are used to hedge the borrowed capital and to service interest claims. And such leveraged buyouts are typical for so-called private equity investors. What does it mean? First of all, what is a private equity investor? Exactly what it sounds like. It's a fund, it's an asset management fund, it's an investor who buys a share in a private equity company. That is a company that is not listed, that is private, and it tries to take over such a company. It will finance this purchase with a lot of debt, with high leverage. It will usually install new management, try a turnaround strategy, and then it will need, after 5-6 years, it will need an exit strategy, and that is usually done by an IPO or some additional leverage buyout by another fund. And these are private equity investors. They are not buying public stock, but they are buying private equity. Okay. And there are some types of leverage buyouts. For example, a management buyout. That's the purchase of a significant portion of equity by the current management or a company's board of directors. A management buy-in. You buy up a significant part of a company's equity by an external management team. A secondary or a tertiary buyout, those are leverage buyouts where a company that has previously been bought in a leverage buyout, where the first investor, the first private equity investor, exits via selling to a second private equity investor. There is one, I wouldn't say famous, but at least it's a well-known example of a buyout and a leveraged buyout by a private equity company in a large German mid-sized enterprise. Does anyone have an example a very famous example where a company in Germany was bought in a private equity deal? I would guess that today you've already had one of their products in your hand. If you go to the bathroom, you will probably use a tool from Grohe. That's a famous German and actually a world-leading manufacturer of appliances in bathrooms. Grohe, and also I think it's Grohe, not Hans Grohe. That's a second slightly different company. But Grohe was bought was the typical mid-sized German enterprise in the possession of the founding family. At some point, they lost track of the company, maybe lost interest, but business struggled. And along came a private equity investor that realized that they could do better than with the current management. So they bought the company, increased leverage, changed management, and after a couple of years it was sold off to the next, and then to the next. I think it's now the third or fourth private equity investor. Currently it's, I think, a Japanese one. And this private equity deal in the 90s or 2000s at least was under the Social Democratic and Green government in Germany, was the start of the infamous Heuschreckendebatte. It's, I think a Heuschrecke in English is, I think, a locust. I think it's a locust. In German, we have this word that especially private equity investors are referred to as Heuschrecken or locusts, because they wander from one place to another. They eat everything and they leave scorched earth behind it. And at that point, there was the first German company that was bought by a private equity investor, and politicians, especially social democratic politicians, feared the end of the world was near, because now financial investors were buying up old traditional German companies. And that example is, I think, one of the better examples where this worked out to some extent, because the company now is, I think, much more stable and financially healthier than it was at that time, because especially in family firms, at some point the founding family is no longer able to lead the business as they should, and they lose interest. So that was a positive example. Obviously, there are some negative examples where private equity investors simply drove up leverage. Take, for example, Karstadt. I mean, there was in some other companies, those were bad examples where private equity investors simply went in, drove up leverage, exited, and afterwards the company was virtually bankrupt. That is obviously also a negative side of this of these leverage buyouts. But there are some other less controversial examples, especially management buyouts and management buy-ins. This sometimes happens with consulting companies, because as you might know, well, you probably don't know, you probably know the only real German consulting firm, strategy consulting firm, Roland Berger. Roland Berger was the first businessman who had the idea of copying McKinsey and Boston Consulting Group in Germany at a time when they didn't really have a foot in the door in Germany. So Roland Berger Strategy Consultants nowadays is one of the top strategy consulting firms in Germany, and they are actually quite large compared to other boutique consulting firms. But at some point, I think Roland Berger and the other partners sold the company, I think, to Deutsche Bank. The Roland Berger was sold to another company, and this is very uncommon, because usually consulting firms, just like law firms, they only work if the top consultants are equity partners. Because if you're not an equity partner, you will not work until midnight for another company to get all the profits. So you need to have an equity stake in the company to do consulting, because otherwise you don't have too many assets, and you don't need plans to work. So you simply start your own business. Yeah? You start your own boutique consulting firm. And after a couple of years, the new owner realized that it's not working with a consulting firm where the partners don't have such a high equity stake in. And the partners and the top consultants made a leveraged management buyout of Roland Berger. And nowadays it's again in the ownership of the partners. And That's a good example where you can see that obviously if the company is sold to investor, then you have management, and the management can buy the company, but in many cases the management doesn't have enough equity to finance this deal, so they need to raise capital. And this then happens in a management buyout or a management buy-in if the management team is external. Okay. Now, in the course of an LBO, an investment bank, because this is about investment banking, the investment bank can take over the following tasks: identifying potential target companies, valuation of the target company, transaction support, placing the bonds, because you need to raise debt capital. It's not about equity, but here, for example, the management team will bring in the equity, but perhaps they need 100 million to buy the company, but they only have 10 million in equity. So they need to raise 90 million in debt financing. And this can be done, for example, by securing loans from banks or by placing bonds. And the investment bank will act as a bank, and it will grant a loan maybe, or it will advise on how to generate debt financing. And then, of course, it can help after the buyout by advising on debt financing, and advise and support the new private equity investors on how they exit their investment. Because private equity investors usually have a time horizon, an investment horizon of, say, 5 years. They go in, increase leverage, finance the deal with leverage and new investments with leverage and debt, change management, and try a turnaround strategy. And obviously they will only buy companies that are currently undervalued in their opinion, that are the hidden champions that could do much better if they only had a better management. And then after 5 years, you should see the first results of this turnaround strategy. And then that time, because they are interested in profits and not long-term investments, they will exit at a good price. And here, if you do it via an IPO, that's usually how private equity investors do it, the investment bank can advise the private equity investors on how to do an IPO. Okay. So what is an example in LBO model? And this is quite interesting because it's not so common in Germany, I guess, to go to an investment bank. But in the United States, in Wall Street, this is the dream of many finance students and finance students in the top schools for business. And the application process in investment banking is quite standardized across the industry. And what usually happens is that you will be asked, you will be given some data in your job interview with an investment bank, and you will be asked to do a model LBO calculation, meaning that you are given some data on a company, you will have estimates regarding the purchase price, you will create a sources and users list that is a list of capital requirements, or maybe capital needs. Capital requirement sounds like a regulatory thing, but a list of capital needs. How much money do you need to do this deal? And what sources of financing are there? Private equity, bonds, equity, etc., bank loans. Then you will need to forecast or make sensible forecasts on your financial statement to see how should this company evolve over the next 5 years, and then calculate a new balance sheet adapted to the new capital structure, because you will increase debt, and then exit planning and estimating the return on equity for your investors. And in the end of this model LBO calculation, you should do an assessment on how much is the return, and should the private equity investors buy this company or not. And this is done in your job interview. And if you are ever, for example, in New York and you go to a bookshop at one of the top schools and top universities there, you will, and even on the internet, you will find job interview guides for interviews at investment banks where you will have mock exams for this type of analysis and for this type of calculations. It's very similar to the famous, infamous case studies with strategy consulting firms. You might know this, that if you interview at, say, for example, McKinsey or Boston Consulting Group or other strategy consulting firms, you will be, I wanted to say forced, no, you will be asked to do a case study with them. So you will be told a certain scenario, and then you have to calculate a few estimates, and you will have to come up with some ideas on what to do. No? Okay, so that's an example LBO model. Okay, and which characteristics make a company attractive? Well, I've already said this. A company that could do much better, with a better management, with a better capital structure, with better management. So a strong, effective management, it is a nice to have, otherwise it will be replaced. And the question then is, how easily can the management be replaced? Because sometimes management has some contractual provisions that the old management will be paid a lot of money in case they are prematurely fired. It's called a poison pill in their contracts. That is, they will swallow a poison pill in order not to get fired, meaning they will, well, no, that's not a poison pill, but that's a golden parachute. They will be paid a lot of money and they will slowly glide to the earth in a golden parachute that is meant to prevent other companies from doing a hostile takeover. Why? Because if you have 10 managers in your top management and each is paid 10 million euros in case the company is bought in a hostile takeover, that will generate costs of 100 million euros to the company in case of a hostile takeover. So that's a measure you can take against a hostile takeover or a leveraged buyout. And here, if you have a good management, you can only hope for a cooperative stance of your old management in case of a leveraged buyout. In case you have a very inefficient management, you can hope to throw it out at low cost. A low debt ratio and a leveraged buyout effectively works in the sense that it increases leverage. It replaces equity by debt, and therefore you can generate a higher equity return. And the prerequisite for this is, of course, that debt is still very low, that you still have a very low debt to equity ratio. Otherwise, you will not be able to increase debt and leverage. So this is a prerequisite for a leveraged buyout. Solid wealth structure, low operating risk, and stable cash flows. Well, this is quite natural. You will not buy a company that is not doing well. Or at least, even if it's not doing well, it should have potential. Otherwise, there's no need to do a leveraged buyout. If it's already bankrupt and defaulted, you don't need it. So you will look for companies with a low price-earnings ratio and an undervalued company, and parts of the company that do not fit to the holding portfolio. That's also an idea. In some cases, you realize that the sum of the parts is actually smaller than all the parts together. And you will buy the company, you will split up the company and sell off the profitable parts and hope that you pay $1 million, and by selling off the parts you will get more than $1 million back. And that's also a famous strategy of private equity investors. Why? Because in many cases this sounds very negative, and this sounds like private equity investors will only destroy companies. But in many cases one has to realize that these companies that are being bought by private equity investors have grown too large because some owners or some managers were more actively engaged in empire building than in doing sensible business. They bought pieces and pieces and companies that never really fit together. So a private equity investor will realize this because it has a neutral approach to this, and it will sell off the parts that do not fit into the portfolio. Okay, that's a leveraged buyout. And I think we've already run out of time, and I'll stop here. But please do have a look at the example of Grohe, because this is, I guess, the most famous example in Germany, and the first one that happened in the leveraged buyout section and the private equity investment in Germany. And yeah, next time in January we'll continue with IPOs, M&As. On a side note, if you are interested in investment banking, I'll have a lecture on investment banking in the master's degree next summer again. And I'll talk a little bit of that in a moment when the recording has ended. But at this point, I wish you all a festive holiday and a good start in the new year. Thank you.